In this week 3 wrap up, I'll review the ratio analysis we did on Nike, Under Armour, and Lululemon. There were some great posts this week on across all the ratios and really showed your ability to translate this financial data into words and be able to make some pretty interesting and reasonable statements about the firm's performance. And that's really what we're trying to get you to do. So it really came through this week, I think, very nicely. On the profitability side, we see that Lululemon has a higher gross margin than the other two firms, and this probably reflects their more of a niche strategy, a niche product, really focused in more on the high end consumers in the yoga exercise class market, whereas Nike and Under Armour are a little broader in their reach and their markets. And so you see Lululemon a little higher margins all the way through. It was also noted in several posts about Under Armour's lower operating margin relative to Nike, was probably reflective of more expenditures on the selling and marketing side as Under Armour tries to gain market share from Nike. So really, Nike and Under Armour are probably more direct competitors. Lululemon is kind of a niche competitor in the yoga and high-end exercise classwear. On the asset management side, probably the most notable thing is the higher cash operating cycle for Under Armour relative to the other two companies. Clearly due to a much higher investment in inventories, and so you would need to ask why. Is this because they're having a hard time selling their inventories, or is this because they're building their inventories up intentionally as they try to expand and grow? Probably more the latter than the former, but it would certainly be worth investigating. Also interesting to note the very low days in receivables and payables for Lululemon, so they're operating almost as on a cash basis as far as their customers and suppliers go. On the return on investment ratios, we see that Lululemon has higher ROA, return on assets, which is driven primarily by their higher overall profitability. But when it comes down to return on equity, Nike really shines, particularly in relation to Under Armour, but to Lululemon as well. Lululemon basically doesn't have any debt. Their only leverage they have, the only debt they have is operational in nature. So they're really not making much use of other people's money to finance the business. If they did, they could probably get a much higher return on equity. They're clearly making the choice not to do that right now. That may change going forward. Under Armour and Nike are much closer when it comes to their financial leverage, but Nike's overall profitability is what really helps them achieve a very nice return on equity, and probably also reflects Nike's just a very successful firm. They're good. Several people posted about this saying, look, Nike does well on all the levers, not just one. And so it's reflected in their ROI metrics. And on the liquidity and solvency side, none of these companies are in any trouble. They all look very strong. Like I said, Lululemon has no debt, no short-term or long-term debt. So the last two ratios, we don't even need to compute for those. And for Nike and Under Armour, they both carry debt, but they're very profitable companies, and they generate good earnings to cover their interest expense, and their current and quick ratios show ample current assets to cover their current liabilities. So there's really no real problems there. Although you do notice that for Under Armour in 2015, and several people pointed this out, there's kind of a big jump in their debt to equity. Big increase in interest-bearing debt to equity. So we'd want to investigate that and understand better if that what's the cause of that. But I don't really think Under Armour's in any real trouble right now. So in terms of key takeaways, I think the main thing is to try to keep it simple. I always try to not compute hundreds of ratios for every company, but with just a small set. I mean, we're only looking at 8 or 10 or 12 ratios here. You can tell an awful lot with a small set of ratios. But remember, before you even begin to calculate ratios, first thing you got to do is learn as much as you can about the company. Learn about its business model, its strategy, how it competes, how it makes money, and understand the industry it's in. to see whether or not you think the industry is a good or bad industry, a growing industry, a declining industry, and how your company fits into that industry and how its strategy is or isn't effective in that market space. So do that first. That'll give you a lot more context for understanding the ratios. Then try to get at least 3 years of historical data. 5 years is better, but at least 3 years so you can start to try to identify trends. And then also try to find at least one or more key competitors to compare with your company, like we did with Nike, Lululemon, and Under Armour. It makes for a much more productive, if you will, ratio analysis.